when you look at the two options, whether it's rent to buy, and if you're in that position where you can't afford to buy, it's okay to be renting.
Yes.
But the big thing is to meet with, an agent, a lender, a financial advisor, and at least come up with a plan, right? So if, okay, I don't have enough money to put down to get my payment where I want it to be, how am I going to get there? What am I doing with my money?
Welcome to the Best of Raleigh with your host and real estate expert, Gretchen Coley, owner of the Coley Group. This show is all about the people and places that make the Raleigh area so special. Here's your host, Gretchen Coley.
So many people are feeling overwhelmed by the real estate market, mortgage rates, inflation. Maybe you're one of them. We see it a lot with first-time home buyers, and what I wanted to share with you today is one of my favorite trusted partners, Paul Norment with CrossCountry Mortgage. He and I have worked together for about 4 to 5 years now. We do a lot of business together. And what I love about Paul is he is an educator first. He's been doing this since basically you got a lineage. Yeah, since you came out of the womb. And he loves educating his clients and making sure that they're getting into the best mortgage package for them. And I think when it comes to overwhelm, the way out of overwhelm is education. So I'm so excited to have you on the Best of Raleigh today. Thank you for joining me, Paul.
Oh, thank you so much for having me, Gretchen.
So we've got lots of topics of conversation, but before we get into all of that, I want to just talk about how you became a mortgage originator.
So, like you said, it's kind of in my blood a little bit. So my father had started a mortgage company back in '98, and I spent summers, with him, watching him, cold calling for him. A lot of people who family-owned business, maybe restaurants, they might have been washing dishes. I was hammering the phone, trying to help him generate loans. So it was always something that I've seen, that I've enjoyed. I've seen the fulfillment that he got in helping a lot of buyers that were told no before, and the impact that I had on his family. And so, like many of the folks that are probably listening, I graduated Chapel Hill in 2009, and that was the height of the financial crisis. So I didn't go to school thinking, hey, I'm going to get into the family business or anything like that, but there weren't a lot of options. And so when I came back to Raleigh, I started studying for grad school and trying to figure out what I wanted to do. And my dad was like, hey, why don't you come intern with me a little bit? Why don't you come help me out with a couple things? And got my feet wet in it and just been running ever since.
There's nothing better than starting in a new industry in the middle of a financial crisis.
Exactly.
Right. So you probably learned a lot of really hard lessons during that time.
It was really interesting to watch because, and it's kind of what we're going through today. So the market became extremely, extremely volatile, and people did not know what to do. People were scared to buy because those that had bought back in '06 were unfortunately very, very underwater. And it was just a lot of fear in the market, right? But at the same time, what we were able to see is how homeowners just are resilient, period, and how we were able to come back from that. And now you see those folks that did buy in '06, '07, '08 that, have been able to leverage that money, whereas if they would have invested otherwise, things would have really, really changed for their family. But going back to what you said about educating, I think that's an important thing right now because you have to kind of put buying a home and home ownership in perspective.
Putting that into perspective with historical data is really important because the market is a little volatile. Like rates go up, they went up really fast last year, and people just didn't know what to do. And even though that's calmed down a little bit and we're starting to see appreciation tick up again, especially in our market, really where we are in rates right now, 7s and 8s, is not historically that bad of a place to be. We just have been jaded by a couple of years of extremely low rates, right?
Correct. And when you think about that too, as far as, where we are from a rates perspective, when, and I'm 36, today's actually my birthday.
Happy
and
birthday.
So thank you. So like a lot of millennials on this that are listening right now on the podcast, I've kind of gone through that same professional trajectory that you had. Like we graduated during the height of the financial crisis. Things started to get better. Wages started to increase. You're starting to establish yourself a little bit in your career, and then boom, COVID happens, right? And then now that we're out of that, a lot of millennial buyers are saying, hey, now it's time for me to buy a house. Yeah. But then they're looking at it and saying, well, no, now I can't buy a house. So it seems like, and obviously I'm biased as a fellow millennial, but we get a bad rap, right? We're the generation that lives in our parents' basement. But that's not true.
If you're living in your parents' basement, call me. I can help you.
But I mean, it's true when you look at it from that perspective. We constantly, we've just gotten beaten down, right? And I think that now the time that as a millennial you're looking to buy a house, and it's once again it's like we have another hurdle to get over. But I do think opportunities like this, where rates do go up, when you look at it from an historical perspective, and I don't think these rates are going to be here for much longer. I don't think we're going to get back to obviously where we were in the 3s and 4%, but we're going to get better into a more stable environment. And so when that does happen, all this pent-up demand is going to explode, especially in our market.
Yeah. Well, let's talk about that a little bit, because I want to dive into the hurdles that a lot of millennials and the generations behind that are feeling. Is that they've seen these rates of 3%. They think that's normal. We saw massive appreciation during those moments of low rates. And I think what most people don't realize is low interest rates are not a good thing for the economy. That means the economy is really bad to have rates that are that low, right? We probably will hopefully never see those again in our life, right? Because that was a really tough time. So when you think about that, we saw massive appreciation in this market, about 47%. In 2 years. And now we're seeing a little higher inflation and a little higher interest rate, but we're still seeing appreciation. So affordability has become a huge topic of conversation. And we're hearing a lot of news from the Times, the Journal, everywhere talking about how maybe it's a better option to rent than buy. And I fundamentally disagree with that for a lot of reasons, one of which is leverage returns and being able to truly acquire wealth and be able to use your investment at the same time, right?
For sure. And I don't think, when you look at the two options, whether it's rent to buy, and if you're in that position where you can't afford to buy, it's okay to be renting.
Yes.
But the big thing is to meet with, an agent, a lender, a financial advisor, and at least come up with a plan, right? So if, I don't have enough money to put down to get my payment where I want it to be, how am I going to get there? What am I doing with my money, right? And, that doesn't mean throwing it into the stock market. There's a lot of options with rates being higher that are safer investments to get returns. But coming up with a plan and a roadmap, because at the end of the day, and what you said about appreciation and leveraging funds, I mean, that's the backbone of the American dream. Yeah. And the system is set up that home ownership is what drives that, is what drives wealth, because you can take a lender's money and you can gain all the returns back. So in a scenario where you buy I'll use my scenario. My first house we bought in 2015, and my motivation to buy was, honestly, I was tired of being the cobbler with holes in his shoes. And so, and rates were starting to creep up, because at that point rates were, mid 4s, and they had just gotten up to about 5.25. And I was like, I'm going to feel so silly because I'm the one that's going to miss this boat. Yeah. And so fast forward, my wife and I, we get engaged, and she's like, okay, all these houses that you like, I hate. And
normal.
We'll compromise on these 2 steps. And long story short, we ended up buying our first home, and we put down 3%.
How much was that?
So we bought our first house for $307,000. And so we put down, a little bit under $10,000. And we also used some down payment assistance. And so
great vehicle.
Yes. And so what's happened now is we had enough equity in our house to do a full-blown renovation. We added a second floor, and the area is really, really appreciated so much, and the impact that's had on me and my family is tremendous. So that being said, I was able to take literally barely any of my own funds.
Right.
And completely transformed the trajectory of my life.
So let's break that down into some numbers. You said you paid 307. Let's just use round numbers.
Yep.
You paid $300,000 for a home. You put $10,000 down. So you
Correct.
financed $290,000. So if you would have taken that $10,000 and put it in the stock market, you would only be able to earn money off $10,000, correct?
Correct, yep.
Now, with leveraged returns, you're able to take your $10,000 and the bank's $290,000, and you leverage the bank's money and you gain the appreciation that comes with that. And you're still in that same house now.
I am,
Yeah.
yes.
So instead of just investing $10,000, which is what a lot of the stories that I'm hearing people talk about say, is that for a renter, you should just take your money that you would put as a down payment for a house and put it in the stock market. The stock market, historically goes up over time. Well, yes, that's true, but you're only able to make money off of the money that you have to put into it. With a mortgage, you're making money off of both, and that leverage is massive.
Yep, and the system's set up where these mortgages are government backed.
Yeah.
So your interest rates are going to be better. You're not going to be able to get the same amount of funds to invest at the same rate.
Exactly.
And the interest is also tax deductible. So you can see that the system is designed to use home ownership to generate wealth. That's why it's such a big part of our economy.
And there are tax incentives when you sell on the appreciation for
Correct,
that
yep.
money, correct? Tell me a little bit about those.
So from a capital gains perspective, if it's your primary residence and you've been there 2 out of the last 5 years, you're not paying capital gains up to a certain amount, whether you're single or married.
And that single amount's $250,000 right now.
Which is a lot.
Married is $500,000. So if you think about it, if you're making, let's say, $75,000 a year and you have to pay taxes on that $75,000 a year, how long will it take you to save $500,000?
Correct.
A long time, because you got to live, you got to eat, you got to do all of those things. Well, fortunately, in the vehicle of a home, you're doing all of those things in the vehicle, right? And it's appreciating.
And regardless of whether you rent or own, you still need a place to live.
Exactly.
And so, a house isn't just an investment, right? For me, it's, first time I introduced my wife as my wife was in our house. The first time we took our kids home. Today on my birthday, my daughter gave me a doll that I had already paid for as my birthday present. But those are memories that I get to have in my own house. It's value to me. And I get emotional talking about it, but I really do feel like that decision that I made that day has completely transformed the trajectory of our family and kind of what we're going to be able to accomplish. But if a house was just about an investment and utility, then it would be so every house would be so basic.
Yeah, it wouldn't be so much about we wouldn't have the investment vehicle that we have. If that was really all it was, it may not be as great of an investment.
Mm-hmm. And I think it's everything. It's a reflection of who you are, also as an individual. You walk into your house and you see the things that make Gretchen Coley. Thanks to my wife, you don't see the things that make me me, but if that was the case, it wouldn't be great. But, it's true, though. It becomes a reflection of who you are, and it's way more important than just, dialing in numbers.
I agree. So that brings me to a couple of questions that we have. Here at the Coley Group, we work with a lot of first-time home buyers. We work with a lot of second-time home buyers, and it just depends on how much time in between is to how much education that you need around that, because buying a home isn't something that you do every day, but it is the American dream, and it is the pathway to truly having wealth in this country. And, whether you're looking to buy, sell, invest, we are here for you to answer your questions and help guide you home. So if you're getting valuable information out of this podcast, I would love it if you could give us a follow. It would really help the show and help us know what topics resonate the most with you. And if you've got some comments, we'd love for you to drop some Q&A down in the section below, and we will certainly reply to you, and you'll be able to get all of the upcoming shows that are coming out. So, Paul, some of the questions that most first-time home buyers have are right now, especially, should I buy right now?
And I think that's such a personal question. Because when you really, I think this is true if you're listening to this now, if it was all about rate and you didn't buy a house when rates were at 2.5, why didn't you buy a house when rates were at 2.5? So there
I
was
can tell you why, because you couldn't find one.
well, you couldn't find
And if you
one.
could find one, it was $200,000 over list price.
Yep, and you had to put, five or 50,000, 100,000 sometimes in due diligence.
And you couldn't see it.
Yes.
You couldn't get in it.
Or you couldn't do an inspection.
No,
Appraisals
nothing.
were waived. So it's not all about what the interest rate is. I think that is the fundamental thing that we have to kind of drive home, but it's more about, okay, when we look at this, one, is this an area that you want to be in, yes or no? Two, how long do you plan on being in this house? Because that's going to affect the decision that we make from a financing perspective. Three, what are your future plans for you, your wife, your family, or if you're single? Is this truly going to be an investment property for you where you want to live in it for 1 or 2 years and then rent it out, right? So we have to kind of look at those things strategically and see how it fits into your personal 1 year, 3 year, 5 year, 10-year goal. And that question is going to be different for everybody.
Well, and I think that's a valid point. And I want to say this. I think it's important if you have those questions, not just to speak to your wealth advisor. Speaking to a mortgage lender specifically is really important, especially someone who's educated. So what questions should a first-time or second-time buyer be asking to their loan originator?
So one of the big first questions that people always ask is like, how much can I qualify for? And I hate that question because it doesn't matter, right, at all. The question should be, how much can I afford? What is my mortgage payment in my budget? So that's the first thing we discuss. And usually with younger couples too, it's okay, have the two of you guys sat down and discuss this together. Because, as you know, like communication is very important in a marriage.
A doesn't always talk to B.
And so just being able to come together as a unit, as a group, and say, okay, you're saying that our payment can be $2,500 a month. He's saying our payment should be $2,000 a month. Let's look at what the difference between a $2,500 payment is on a house and a $2,000 payment.
That's good advice.
So let's take out the 2-car garage. Are you good with the 2-car garage being out? Well, no, I need that. Okay, let's get you back up to $2,500. How can we, with rates being high, what can we take out of our budget, right? So.
Or what other areas can we search in, right?
Correct.
Location is always important, but there's 4 different ways that we can tweak our things that we're looking for in a home. There's price, of course. There's down payment. There's features in the home, like what things are in there, like a 2-car garage. There's where a home is in regards to location and the type of home, whether it's condo, townhouse, duplex, single family. Those are all adjustments that can be made to help tweak where you are in your monthly payment.
And that's what's so important, I think, is when you sit down with, a real estate agent and a lender that's working together that has the same goal for you. It's not just simple as, okay, we found house A, how fast can we get you under contract? How fast can we get you to close? What's my interest rate? Okay, let's go. It's how does this fit into the totality of your life?
Yeah. Everything that we do is relationship driven. And as I've said, we've worked together for almost 5 years now. We build relationships. We do so many things together with your team and my team with CrossCountry. It's become a great thing. And in fact, at our client appreciation events, people expect to see Paul. They expect to see him there because he's done so many of our loans. And, oftentimes people say, well, how do I find a mortgage lender? And, the best advice that I can give you to finding a phenomenal lender is to talk to your real estate agent who has a trusted partner, because everybody does mortgage lending, and it's a big business, but it's very transactional. And what we try to do is take the transaction piece out of the mortgage origination, and we try to make it about a relationship. And I know that over the time that we've worked together, you financed multiple properties for our clients. They come right back to you the next time as well.
And I mean, one of the big differences, right now, a lot of clients that I work with, new construction is so big, and with that comes a lot of incentives and different things that they're able to offer through their in-house lender. And I have people all the time that's like, I feel so bad that I have to go with this lender after all the work you've done. And I'm like, please don't feel bad. Like, everything we've done has gotten you to this point, and that's what's most important. So like you said, to me, it's not at all transactional. So when you're looking for a lender, and to be honest, like, for some people, some people listening are probably like, I don't care about any of that. Like, I just want to get the absolute lowest possible rate. I don't care about the customer experience.
So tell me why that's so wrong. Because that is one thing I hear is I want the lowest rate. And oftentimes when we've run the numbers, we found that just is a hook and it doesn't
course.
always work out the way that they think it's going to work.
So in our market, a lot of times what you see, and it's kind of like, the same with like any goods that you might purchase. Like, yes, this might be a little bit cheaper or whatever else, but the customer experience is completely different. The relationships they have with local appraisers, relationships they have with local agents, title attorneys, things like that make this transaction go a little bit smoother, don't exist a lot in those dynamics. And also, too, the devil's in the details, right? So you can have a rate that's, a quarter to 3/8 of a point lower, and that person's never going to explain to you, hey, no, but you're paying X amount in points for this. And what's your break-even point? How long do you need to keep this loan for that to make sense? And so by the time you get into the transaction and you realize, oh, wait, no, I'm paying, $3,000 more for 3/8 of a rate, it's too late. Because they haven't taken the time to show you, okay, here's option A with lower closing costs, option B with higher closing costs. And let's look at how long we plan on being in the house. So, a lot of times, like in that type of stuff, the devil's in the details. And when you're working with a lot of those online lenders, unfortunately, it's, people that haven't been doing it very long or fresh out of school that really don't know the difference.
I agree with you 100%. I think that's a really important thing. And it comes down to, again, education and comfort level and being sure that who you're working with has your best interest at heart. And that's
Correct.
what I've heard you say over and over and over is really, what is it for you? Why does it matter to you? What's important about this to you? And how can we make this work for you?
Yeah.
Always about you. So just a couple of final things before we end this, because this has been a great conversation. But for someone who is extremely overwhelmed by the market and they're feeling like rates are bopping all around and they feel like they're never going to be able to buy because the house that they want, the numbers just don't make sense. What are some of the options that could help them maybe get a lower rate right off the get-go?
Well, step one is to breathe. Like, just... Like, it's okay, to feel stressed, to feel overwhelmed, because it is, such a high stress situation in our market because it is so volatile.
Yeah.
And it's tough to really get good answers and good direction because, depending on who you read or what you're listening to, you're going to get two very conflicting answers. So the first step is just, honestly, to breathe. Step two is to really understand what your options are. Right, so we have to take a look and say, okay, I can rent house A at X amount of dollars per month, and I plan on being here for X amount of years. And then we can look at, okay, this house here, this is what your mortgage payment is going to be like. But also what we've been taking advantage of a ton in this market are, buy downs, where we're having the seller come in and subsidize your mortgage for the next 2 years.
Explain that to me.
So yeah. So let's just say, for an example, we have a house, that's on the market for $400,000, and the rate today is 7%. So what we'll do is we'll calculate the numbers. So what's called a 2-1 buy down is the most prevalent one we do, but we calculate the savings from a monthly perspective, and we times that by 12 for a rate of 5%. So 2 percentage points lower the first year, and then 6%, so 1% lower the second year.
So the first year I could get a rate, if rates today are 7, I could get a rate for 5.
Yep.
And the second year I could get a rate for 6.
Yep, so we calculate that amount, and then I work with, an agent and say, okay, instead of going in...
What do you mean, an agent? Me?
Well, Gretchen Coley. I work with Gretchen Coley, and I tell her, instead of going in below asking, let's go in at asking and let's do this. Let's get $10K in a buy down, or $10K in concessions to cover that buy down, right? So it's the ultimate hedge. So if everything you're reading is saying, hey, rates are going to come down, I need to wait until rates come down, this gives you that hedge. Because, in a 2-year period, rates probably aren't going to hit exactly 5%. So you have that subsidy where you're having that monthly payment as if for that first year your rate's 5 and the second year your rate's 6.
And that's worth about $400 a month is about what
In
that
that
equates
scenario.
to. In a rough estimate, it would save you $400 the first year and about $200 per month the second year.
Correct.
So it does give you a lot of options, and we leverage those a lot. That
Yeah.
has been a great incentive to really help people get over the hump.
Because too, when you look at that, I mean, that's 80,000 in buying power. So in that scenario, you've looked at houses at 400, but really where you want to be from a payment perspective is 320. That's giving you that for that year while you're
That's
letting
great.
rates come down. Because like we saw during COVID, like the second rates get to a more comfortable level, the market's going to spike again. And what I think is really going to change is, and especially for first-time home buyers, because one of the drawbacks of inflation, it's hard to save money. When
So hard.
When it costs so much money
Yeah.
to live. So, when the market shifts, what's going to end up happening is you can have all these folks that own a house now that have been waiting for rates to drop to sell, and those are the people that are going to get back in the market. The people that are more established than you, that have more money, that are older, and also have a house to leverage to sell, and that would have a lot of equity in it. So now you're competing with all those folks again. And so as first-time home buyers, that's what I've talked to you about this multiple times, but I've really enjoyed this market.
Yeah.
Because before it became everything was so fast that it felt very transactional. Whereas now I feel like we can really make an impact on people's lives, because these people mainly that we're helping, we haven't been able to help for the past 2.5 years.
Look, as a child who grew up, my mom never owned a home. It was a really rough situation. We moved all the time. And all I ever wanted was a home, somewhere that I could paint the bedroom wall, somewhere that I could have the same friends all around me, that I could stay in the same school, that I could have the same Christmas tree in the same place. That's all I really wanted as a child. And I think it goes back to what you said. Home is so much more than the four walls. It's so much more than the mortgage payment. Having a home is safety. It is comfort. It is where all of your traditions and your memories are made. It's where you retreat to it. And we saw that during COVID. And, the essence of home is so much more than a house that you rent and you move 3 years. It just, for a child and who grew up like me, being able to have that was everything I've ever wanted, which is why, one of the reasons that I'm so passionate about real estate is the same for you. I love seeing people do something they never thought they would be able to do. And I think we're at a pivotal time right now with millennials and the generation coming behind them. They feel like they may never have an opportunity to have that. And that is wrong. That is a lie that we're telling ourselves, that society is telling ourselves. I've always believed where there's a will, there's a way. The right education will help you.
And I agree 100%. I mean, like we said, if it's a mindset, right? So if owning a home today is not obtainable because of market conditions or rate, whatever, let's at least figure out a way to get you there, right? Like, what are we doing with the money you're saving? How are we budgeting your money? Are there options for you to pay less than rent? How can we figure out a way to get you from point A to point B? Or have you looked at, like you said, other areas? Because what you said too about a home is, especially for our generation, where so much of work from home happens, right? So, I have talked to so many people that do work from home, and for years it seemed like having a second floor wasn't that big of a deal, but now it is.
Oh, it's not big now.
So you can have that separation
Yeah.
between, family and work, right? And so it means so much to so many people, but it's important if you feel that way now and you feel overwhelmed and you feel like I can't do this, let's figure out a way for you that you can in the next 3, 5, 10, however many years it takes, but at least have an idea of, okay, it's not completely out of reach.
I love that. And all of this talk is great, but talk is one thing and action is another. So if you're feeling any of the emotions that we've talked about, I want you to reach out to us. Paul, how can they find you?
So they can email me at paul.norment@ccm.com. That's NORMENT. Or they can go to ccm.com/Paul-Norment, NORMENT. And also, I'll leave all my contact info, guys. Text, call, whatever's easier for you.
And we are here if you are looking to buy or sell. You've heard a lot of great information in this podcast about the overwhelm that first-time homebuyers are feeling. It is a real thing, and we are here as trusted advisors to help you with that. You can find us at thecoleygroup.com, but we have people call, text, email all the time. And we love answering these questions, even if you're not ready to buy now. We are here for a year from now, 5 years from now, as Paul said. So feel free to call, text, email, or schedule a Zoom call, and one of our advisors will help guide you home. Thank you so much for joining us in today's episode of The Best of Raleigh. You can find us on Apple, Spotify, and on YouTube. We drop episodes weekly. You do not want to miss out. We'll see you. Bye.